Hey, what is up guys? It's Chris with Crypto Profit again. In today's lesson, we're going to be learning about divergence and the RSI. So the divergence and the RSI are really cool tools because it's what allows us to make accurate shapes, and it's also what allows us to make high profitability trades because that way we make decisions based on what the market is telling us and not what we want the market to do. So let's just go ahead and hop right into it. Let's talk about this right here first. This is going to be our RSI, and all you basically need to understand is that we have this purple zone right here, and that when we are above this area right here, so when the RSI is above 70%, it tends to indicate that the market is overbought and that we're going to start heading in the opposite direction. When we're below it, right here at the 30%, it tends to indicate that the market is oversold and that we're going to go up, okay? And then right here, as you see, the RSI right now is at 23. Now let's talk about divergence. And divergence is this right here. Lower highs, lower lows, higher highs, or higher lows. Okay? So now there's two different types of divergence. There's going to be apparent divergence and hidden divergence. So when it comes to divergence, when you have lower highs and lower lows, it indicates that we're in a downtrend and that we're going to continue to go down, okay? So that would be apparent divergence. And the best way for you to visualize the difference between apparent divergence and hidden divergence is going to be these two shapes right here, okay? So right here, I went ahead and drew a descending triangle telling me that the market was going to go in a downward direction, right? And the way we drew this descending triangle is because we were starting to have lower high after lower high after lower high with lower lows, correct? So now I drew this descending triangle because I thought that we were going to go ahead and have a drop. And as we see here, this shape went into fruition and we went in the downward direction and we broke from this channel right here down to this one right here. And the way we saw that this shape was accurate is that we started to have full body candle formations below both the support and resistance line and below the shape. And the reason I drew this descending triangle is because when we look over here to the RSI, is that we were in a healthy 50 to 60% and we are going in a downward trend, right? Telling me that we're going to continue to drop. But when we look here, I went ahead and drew a falling wedge shape. And like we learned in yesterday's lesson, falling wedge shapes indicate that we're going to start going up. And when we look at the falling wedge, we start to look that we have lower highs, right? And lower lows. And you're asking yourself, well, Chris, why is it that the market is going down and we're having lower high after lower high? Why would you think that we were going to go up? Well, when we look over at this area right here, the RSI started to get close to that 30%, right? And even though we're in a downtrend and that we're going to continue to go down, since we're getting close to that 30%, the RSI is telling me that we could potentially have a short-term rally and start heading in the opposite direction. That way, we can start getting this RSI back up so that we can continue to go down, right? And as you see here, this shape went into fruition and we had a bull run, a short bull run that's temporarily, and we went down from 3,100 all the way up to 4,200, and now we're going to go ahead and continue to go down, right? So that's why it's important for you to realize that both divergence and the shapes and the RSI are just tools to help you make a more informed decision. And I'm going to explain to you guys, show you guys examples of why it's bad for you guys to make your trades and your strategy based on only the RSI and only some type of indicators. And I'm going to also show you guys why it's important for you guys to look at multiple time frames. That way you guys can make an informed decision. So now I'm going to go ahead and show you guys the opposite. So right here, I went ahead and drew an ascending triangle because I knew that we were having a short reaction rally and I saw potential for us to go up so that we can start getting that RSI to go back up, right? And what happened? We went up. But then when we were around this area right here, we started to capitulate, meaning that we were just going horizontally and the market hadn't made its decision whether it wanted to go up and it wanted to go down. But I decided to draw a rising wedge, and rising wedge shape means that we're going to go down. So a lot of people in social media and in the news were saying that because we were capitulating above the $4,000 mark, that we are going to go straight to the moon and that we are going to go back up to 6,000. So you're asking yourself, Chris, why did you draw a shape saying that we're going down if everyone else is saying that we're going up? Because when we look here, that RSI was starting to show that we were overbought and that we were going to start going down, and the overall trend in the macro scale is telling me that we're going down. So I figured that, hey, look, this is just a reaction rally right here so that we can get the RSI back up, and now we're going to continue to do our trend and we're going to go ahead and continue to go down. So you're asking yourself, how do you know that the market is going down, Chris? You keep saying this, but you're not showing us how you know that the market's going to go down. So when we look at the weekly, you notice that we are capitulating. We were just going horizontally. And then when we look at the RSI, we were around 50%, right? It could have just as easily gone up, but the market decided to go down. And when we started to go down, right, as we see here, when we got to this area right here, so when we hit that new yearly low, what happened? We went from 3,100 all the way up to 4,200 because we touched that 30% on the RSI. So we had a short reaction rally, right, so that the RSI can go back up. As you notice here, we're not touching that 30% anymore. And what happened? The market went up. But now that it's back up, we can continue to go down. You might have another short reaction rally to go up, but overall, the trend is telling me that we're going down. And don't worry if you guys don't understand. It's okay, because the reason I think that it's going down is that I'm using all the indicators. So right now, we're just focusing on the RSI and divergence. And later on, I'm going to make a video talking how you can put everything together. That way you guys make really good trades. So now I want to show you guys an example why it's bad just to only rely on the RSI and divergence to make trades. So when we look over to the 15-minute right here, as we see that we're going horizontally, right? Look at the RSI in the 15-minute. Notice how we're way past below the 30% mark. And if you were placing a trade based on only looking at the RSI, you would have noticed that in this area right here, the RSI was below 30%, and you would have placed a buy order because that means we're going back up, right? But then look at what happened here, right? We went down. So if you would have placed a trade here, if market would have gone down and you would have lost money, right? So that's why it's important for you guys to not rely on the RSI as an indicator, to make your whole strategy based only on the RSI, and you want to use multiple things together, because you would have gotten wrecked here if you would have placed a buy order, okay? And right here, as we start to notice that the RSI went down, now we're starting to trade in this area, and as we see here, we're starting to show signs of capitulation, that we're going to go sideways, the RSI is going to go back up. But when we look over to the 4-hour, it looks like the RSI is super low and that we're going to shoot all the way back up. But when we go over to the weekly, start to notice that it's not really as big of a deal as it appears. So that's why you want to look at multiple time frames. You want to use the shapes in both your support and resistance lines and other indicators to give you a more informed decision whether the market is going to go up or the market is going to go down. And that way you guys are not tunnel vision or blindsided and making decisions based on where you want the market to go and not where it's actually going. So again, in a nutshell, RSI, all you need to know is that if it's above 70%, it's overbought and it's going to head in the opposite direction. If it's below 30%, it's oversold and we're going to go up, right? Divergence, higher highs, higher to lows, lower lows, lower highs. So that's basically divergence in a nutshell. As always, remember to have a great day and to trade responsibly. And as always, have a great day.